Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Are you Wall Street's widget? You are if you have a pie charts or us portfolio. Folks, welcome to Your Money Radio, where we show you how to break free of the shackles that is Wall Street. Because Wall Street thinks that your money is their money, and they're going to take your money and spread it out among their real clients, the California Muni Bond, the New Jersey Muni Bond, the Treasury Bond, the tech stock, the Chinese emerging market, all the countries, Europe, Asia. And then you're going to have 40, 50, 60, 80 stocks. Folks, do you buy rotten fruit for a balanced diet? No, you just want the best of the best during good times, and then you want to get defensive during the bad times, because when it hits the fan, all the correlations grow together and it all goes down together. That diversification story is a lie. It does not protect you on the downside. By the way, modern portfolio theory is a lie. It's been debunked. It's not true. Why is that? Because the returns do not fall under the normal standard distribution in statistics. It's not under the bell curve. They're assuming returns are under the bell curve, and they're not. The new science, the real science, portfolio management, is sequence of returns. Google it. Actually put it in Perplexity now. Google's old school. Google's the horse and buggy. You need Perplexity. In any event, it's the order in which the returns come that determines your own individual success and when you start and how you manage drawdowns. It is very important. Okay. And that's what this show is all about. So before I go to the team, we're the most transparent advisor on the planet that I'm aware of. We're putting out daily market content every night the market is open. The team puts out a 10 to 15 minute daily market newsletter where they talk about the short-term, mid-term, long-term strength or weakness of the markets, stocks that are looking good or looking weak, which you should avoid, and then moves that we made in our own portfolios. We keep clients abreast on a daily basis. We don't do quarterly updates or semi-annually updates or annual updates. We do daily. Every day we update for people that really want to know what's going on. So before I go to the team and our new studies, because we share most of our research, we got some proprietary stuff, but we share our research. So before I go there and bring you under the tent, I have one and only one question for you. What does your advisor sound like? What does your advisor do, or what do you sound like if you're your own advisor? Because I'm telling you, you should audit yourself and you should audit your advisor and then compare it to Revere, because just a 2 or 3 or 4% spread on an annualized average basis can be tens, hundreds of thousands, or even millions on the back end, depending on how much you start with. It's not just 5 or 10%. The variance is not just a little bit. It can be huge on the back end. So if you got $500,000 or $1 million and the difference is 3 or 4% a year, that's not $10 or $15 or $20,000 on the back end 10, 20, 30 years from now. You're talking about hundreds of thousands of dollars you left on the table. Think about it. Now, I'm going to go to the team now, and we're going to talk about these. Now, Don, when I was gone the other week, Don actually brought up this new strategy that a couple new strategies we're talking about, and he's going to update you on those, because we're constantly upgrading and increasing our knowledge base, and we're also incorporating AI, which is extremely helpful and streamlines our research. It now takes the guys minutes to 20, 30 minutes to get ready for the morning review and the market open versus a couple hours before. Ted and Connor have actually streamlined this AI search to do all the research, to do the screening that now takes 10, 15 minutes. Before it was taking 2 hours. What are you doing in your portfolio? So with that, I'm going to go to the team, and what the research I'm going to go to the mailbag first, but we got Maximus for gaps. It's our gap studies. And that's going to be proprietary. And that really is extremely promising. So far, the data looks like you can make a multiple of the market, 2 or 3 times the market. We don't know that yet. We're still researching. We got a data scientist. We got some outside analysts looking at this, and it's some really exciting stuff. And so keep abreast, because we will update you in real time as we find out, as we get our data back. And then we also have Optimus, which is our name for the optimal name for your own portfolio for Growtection to Turbo. What's the optimum mix of Growtection or Turbotection? Growtection has a maximum position size of 8%. So its mission statement is to make market-like returns, S&P-like returns, but with far less risk. We've done that in spades. We've actually crushed that. Now, Turbotection is trying to create alpha, trying to make excess returns. It's also done very well and done that. But its maximum position size is 12.5%. So it's a little closer to the kind of canceling methodology, taking bigger position sizes and a few fewer positions. But it is a little bit more volatile, especially on a daily or weekly basis. We still got the big protection drawdown, so you're not going to get caught. We're not going to ride it down 25, 30% with bear markets. We still got a sell discipline on all our portfolios. So Turbo has the same rules as Grow, except they can have larger position sizes. And our final study, our third study, is REX, R-E-X, and that's actually looking at both the value proposition, the value of the account, the price, the dollar amount, and the risk factor, the volatility factor. So we're looking at both that, because we always say price is truth, and we manage risk first, and the returns take care of themselves. So the two things you've got to manage are the gain or loss, the price of the stock relative to the risk. How much risk is that? So we've got both of those measures on the portfolio. So not only do we have a quote stop loss or risk measure on every individual position in the portfolio, we've also got a quote stop loss and volatility measure on the entire portfolio as a whole. Because it's not just about the individual positions within the portfolio, it's also about the correlations with each other in the portfolio, the positions relative to each other. Okay, so with that, I'm going to go to the team, and first we're going to read a mailbag. We've actually have clients and prospects and listeners who follow us, and they always ask us questions. I get questions every week, all the time, and we read those to bring you under the tent to understand this. Now, this is from a new client that just came on board. Okay. Hi, Dan. I recently transferred some IRA funds for my wife and myself. I had a question about the cash sweep. It is earning a paltry rate of return, less than 1%. That's the Schwab core money market he's talking about, while sitting idly at Schwab's FDIC insured bank. The reason I ask is Fidelity did the same thing, but I instead elected to invest in Fidelity's government money market, returning anywhere from 4.5, now closer to 4. It's been coming down. Do I need to change my account settings to make this change? I see Schwab has SWGXX that seems comparable to Fidelity FDRXX. Thanks in advance, BH. Okay, then my response, and this is very important, folks, listen to me. Do not change the settings as we handle everything. We always have approximately 10 to 20% in the core money market for speed of trading, because the treasury money market has to be sold and put into cash, and then you use the cash to buy the stock. So it becomes so it slows down trading and or incurring trade violations, meaning a free rides. I call it free rides. If you do it too fast and you accidentally use the margin like in an IRA account. If we believe we will hold lots of cash for longer, we will sweep into the treasury money market. But don't miss the forest for the trees. Our total return, our annualized, we're making low double-digit returns with no bear markets, okay? Our total return includes dividends, interest, capital gains, everything, including that money market interest. We are very cognizant of holding idle cash, And I also said, by the way, I don't know if you're aware, but Fidelity no longer sells those other Treasury money markets automatically to buy your next ETF or stock. You must actually actively go in there now and sell the Treasury money market to put it in Fidelity's core cash and then place a trade similar to Schwab. So Fidelity is actually slowing down and causing speed bumps just like Schwab did. But here's the point, folks. At Revere, because we're very active and we're making changes all the time, this is active management. This is not pie chart to us. We need about 10 to 15 to 20% to get in and out quickly. And we're willing to sacrifice that interest rate differential on that small portion of the portfolio, that 10 to 15%, so that we can make big returns on the stocks. I'm not worried about the 5 or 3 or 2% in cash. Okay? It's not nearly as important or material. Now, during 2022 bear market, when we looked like it was going to be prolonged for a while and we built up 30, 40, 50, 60% cash because the market was, we were in a bear market, the market's going down. Don actually bought a bunch of the Schwab Treasury money market and we held it for weeks and months. And then slowly he will peel it off and put it in the core. So Don will actually, and the team will actually manage the money market. If it builds too much, they will buy the Schwab Treasury money markets, but they'll still keep some in core for speed of trading. So we're constantly managing the cash, and that is a kind of thorn in everybody's side. That's just the way it is, and you've got to manage that. But we are acutely aware of that, folks. So, and you should be too. And you should be aware of your idle cash. And if you're going to hold it for a while, you should put it in a Treasury money market. But if you need it for trading, you got to have at least a couple trades loaded in the chute. All right. So that was the mailbag. So with that, I'm going to go back to Don, and we're going to start talking about these three new things we're rolling out to clients. So Don, take it away.
Yeah, thanks, Dan. Let's start with Project Rex. This one has come along a lot, a lot more quickly than I expected, and we're to the point now in beta testing that anybody that's listening, we can all you need to do for a portfolio review is send us a list of your tickers and the percentage that you have allocated to the portfolio. That's it. A CSV, one with the ticker, one with the percentage that you have allocated. We can run it through our process, generate your volatility adjusted beta. This will be eye-opening because we often say the typical advisor underperforms because they've got not enough allocation during bull markets and too much allocation during bear markets. So that one file you send us, we can give it a volatility adjusted beta score. But even more than that, we can, with a few rules, generate a balance at risk amount of drawdown that you should see before the market would become risky or unhealthy enough, and this is actually below the 200-day moving average for the major indexes, before you should either be fully hedged or not own any positions anymore. So anybody that's curious, just email me, don@revereasset.com, with a little CSV file, ticker in the first column, percentage of your portfolio in the second column. We can run it through our beta version of Project Rex, and it'll generate your volatility adjusted beta and also what your balance at risk is if you were so inclined to protect your downside. The second project Dan mentioned, Project Optimus. This is with the rollout of Turbo. It's been very successful. It's also more volatile than Grow, and we've had some people comment on that. They're overjoyed when they see a stretch of fantastic returns that like Turbo has put up over the last 7 trading sessions. But it is volatile, and sometimes it'll underperform the market. That's by design. You don't magically get all of the upside without zero of the downside. So we're crunching some numbers to come up with what would really be the optimal percentage between Growtection and Turbotection to smooth the equity curve. And this could really fall into 3 different categories: most aggressive, middling, and then least aggressive. And we'll be discussing that with our clients closer toward year end. And then the third one is just really getting started, Project Maximus, where we've got tens of thousands of gaps in a database, and we're working to determine. Basically, think of it as no different than what a cup and handle pattern is. We look to replicate cup and handles all the time. It's just a classic pattern that breaks out all the time. We're kind of applying the same logic to the pictures of what gaps worked and which ones didn't work, and what should the expectation be 1 day, 2 days, 3 days, 4 days, etc. After the initial gap works. To identify, the purpose of this is to identify which ones to get more heavily invested in, as opposed to which ones should we quickly cut right off the bat. Let me give you two examples that are in the Grotection portfolio right now. Two stocks that gapped up on the same day. This is Snowflake. This actually had the more impressive gap up. It was up 20.3% on 758% average volume. We look for this all the time. Broke out of a consolidation, but it's gone nowhere since then. In fact, it's testing our stops right now below the 8-day moving average. It poked its head 1 day below the lows of the gap up day. That's not optimal, but we see it all the time. But then it got back above the 8-day moving average, and our expectation for this is that it should have continued to ride that higher. We're not seeing that today. Volume is extremely light, but it's breaking down below the 8-day moving average. It's got the 21 under there as the next potential support. But look at the relative strength on this since it happened. And let's compare that with MongoDB, gapped up 38% actually on 671% average volume. Day two made a higher high, and look what it's been doing since then. Riding not only price higher and the 8-day moving average higher, but the relative strength has been increasing as well. So it's a tale of two gaps. This one we didn't initially judge as more powerful because it still had this resistance over on the left side of the chart at around the 350 area, but Mongo doesn't seem to be caring in any way, shape, or form about that as it continues to work higher. As Mongo in Blazing Saddles said, Mongo just game in pawn of life, and that's what we treat these as. We don't know how they're going to come out, but we do know historically that there is some good action and there's some very weak action post gap. But that is Project Maximus that we're looking for. That's to maximize the return of episodic pivots, earnings gaps, whatever you want to call them. And never will we ever stop trying to improve our portfolios and our returns while decreasing the risk for our clients. And as technicians, we've got not only tools in our toolbox, but we're building new tools all the time to help that get done. So that's an update on the three projects. Let's go to the S&P 500 here. And plain and simple, we are on day 3 of a breakout above the 6,500 level, and it's sticking. We're approaching 6,600 as resistance. So let's go to a 30-minute chart on this. 6,500, let's draw a line here. So we popped above it back in late August. It couldn't hold. We popped above it again on September 5th. It couldn't hold. We popped above it again on September 8th, and it couldn't hold. We tried it again on September. I'm saying I'm talking about what the market is doing, not Revere. We obviously don't control this. September 9th, it tried again, failed in the morning, and then closed very strongly. Next day, this was Wednesday, made a new all-time high on a gap up, but faded, but did hold that 6,500 level. And then this was on PPI came out, and then CPI came out Thursday. Gap up, made the low within the first 15 minutes. Very strong morning, and then consolidating in the afternoon. And here we are on Friday now. We're just consolidating near the highs of this very tight range today, only a 14-point range on an index that's trading near 6,600. So the market is not giving back the gains that it got yesterday. Basically, day 3 of a breakout now above that 6,500 level. The 8-day moving average is above that 6,500 level. We use that as our ultra short-term trend indicator. And in the healthiest of markets, you can see several instances of this. We ride above that, and leading stocks ride above the 8-day exponential moving average. It's a big part of our overall position sizing and trading plan for individual stocks as well as indexes. And the 21-day moving average next week will come up to the 6,500 level. So nothing to complain about, obviously, if you're a bull. If you're a bear, why are you a bear? You're just defying what is actually going on in reality. And the reality, it's a harsh reality, but I heard a quote recently: harsh reality is better than false hope. If you are waiting for the market to get bearish, that is false hope. And it's been false hope going all the way back to April, as this huge uptrend has taken place after a shakeout over fears of what tariffs were going to do to the overall economy. We got through that. It was about a 2-week volatility. And then our rules got us out at the 200-day moving average here, particularly out of this 10% move lower below the 5,500 level. We give it a little bit of room here around the 200-day moving average, because history shows you often bounce around that level before a bull trend resumes. But we dodged all this nastiness below 5,500, and then our rules got us back back above the 8-day moving average, back above the 21-day moving average. And we've had one close below the 21-day moving average during this entire time, going back to April. And this gets back to what I say all the time about the typical pie chart. They did nothing during this sell-off. Did we know it was going to bounce back? Of course we didn't. Nobody did. You can say that you thought it did because the market goes up long term. But if you were close to retirement and all of a sudden you lost 20% of your portfolio in 4 weeks, there's a very possible chance you're going to panic sell and then not have rules to get you back in. We describe it every night on video at Revere, exactly what we do, exactly what our current stance on the market is, and we never predict what's going to happen next. We ride the wave, and that's what we're doing right now, riding the wave. It's a bull on a surfboard. I hope the bull stays on as long as he can, but we're sticking with them, and we're not selling just because we want to sell. We take offensive profits when you get too far extended from reasonable levels. We do that all the time. We talk about it on video when we do it too, just like we did last night. I highlighted how Ted and Connor did some offensive selling in A-Lab, which just has been a fantastic performing stock. Did it earlier this week with a separate ticker too. But it's knowing about alpha. The alpha that we provide is as much about knowing when to increase exposure during bull markets as it is when to decrease exposure during risky or bear markets. And that's what we do here. We are completely transparent about it. We're very proud of the product that we put out. And in fact, overnight, we crossed the $350 million assets under management mark. We've got 99% of our clients, 99+%, are extremely pleased about it. There's always one or two that won't be, but that's just part of dealing with personalities. And give us a shout. Send me your sample tickers and allocation to your portfolio, and we'll get back with you with what our take is on your portfolio. And I hope I don't get 500 of these, but
Well, I do.
I put it out there, but we can process this in. We're working on converting this so that we can process it in a batch mode too, so that we can run a bunch of portfolio risk metrics through Project Rex. So that is it from my end. And
I got a question for you, because you mentioned, you made a comment a little while ago where you said something to the effect of, in the strongest of markets, meaning in the strongest of markets, these things happen, right? So my question is, are we in the strongest of markets right now? What is the market telling us right now? Because I've got all these people, they're calling me, they're scared to death, and they're thinking we need to sell or stay in cash because they're scared. But what is the market saying?
Well, they were scared here, and 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 they're also scared here. They were probably scared here as well. Those were all during uptrends. They were equally scared during the pullbacks. There's a time to be scared and a time not to be scared. The only time to be overly scared is when the S&P 500 is below this nasty black line. That's the 200-day moving average. It bottoms, it starts coming up. There's time to be less scared. And that's what we talk about in the videos every night. We show our two key statistics for both of our portfolios. We talk about what we're doing. We talk about what we're watching. We're talking about standout strength and weakness. And people are going to naturally be scared. But we're going with the math, Dan. We're going historically what happens, and that's good things happen when the market is above. The indexes are above the 8-day, 21-day, 50-day, and 200-day moving average, and that's where they are now. And until something changes, that's why we have a keys to watch every night in our videos. Yeah, when one of those keys changes, and it's boring at times to repeat the same keys, but that's good. Boring is
rinse and repeat. Listen though. Yeah, if you're not scared, folks, if you're not scared, you don't understand the deal. If you're not scared, we need to talk, because I'm scared. I mean, I'm scared because it's my money. It's all my money wrapped in here, and my mom's money, and my wife's money, and my family's money, and Don's money, and his wife's money. So you don't think we're watching this like a hawk? If you're not scared, the reason we have rules is to get out of our own way. So that Don made a comment the other day, and it's just classic. More losses. There have been more money lost trying to avoid the next bear market than the bear market itself, meaning the opportunity cost. People moved to cash, the market kept going up. Folks, you can get in the market if you have a sell discipline, because you've got an escape hatch, you got a parachute. It's okay to jump. You've got a parachute. All right, Don, what do the guys got?
Well, let's take it over to Connor first, and he's going to give two prime examples of a short-term strategy that we use to get into strong names on temporary weakness, and that's the 60-minute stochastic cross. Take it away, Connor.
Yep. I thought it'd be good time to show some real examples that we did in TurboTaction using the 60-minute stochastic. Don's obviously talked about this. He's the one that kind of, brought it to my attention, and something that we've certainly added into the toolbox at Revere, and can find great success with it. So one thing to preface when using the 60-minute stochastic is you don't want to use this in a stock that's in a downtrend. My segment last week was relative strength. So the stock has to have relative strength. But the basis of the 60-minute stochastic is we are trying to find a low risk entry in a stock that is going up, that has a short-term pullback. So the first one that I want to talk about is Alibaba. And I utilized 60-minute stochastic on September 4th at 131. And if you show that on the chart, track price, September 4th, this had a pretty oversold stochastic, as you can see, Don pointing out. And it wasn't just the 60-minute stochastic. You had multiple areas of confluence. And that's another thing, is that you want to stack the odds in your favor. So perfect. Yeah, you can see that daily chart is Well, why did we like Alibaba? Well, it had a great gap up on earnings, put in a day two higher high, and then it started to pull back. Was there anything wrong with the stock? Probably not. It was just pulling back. Some people might be taking profits. And as it pulled back into that 8 EMA. So that was number one. And it almost retested gap day lows. That was another thing. So, it was a percent or two above gap day lows. So that's if it went below gap day lows, that's the market probably telling me I'm wrong. And then you also had the 60-minute stochastic entry. And so all three of those signals lined up, took a position in there at 131. And then September 5th followed on with an additional buy as it followed through above the prior day's high. And then it also reclaimed that high volume close as well. And you can see since then, since that pullback, the stock has been really strong. It's been quite a nice mover. And we actually trimmed using the 60-minute stochastic as well, as it was quite overbought and had 4 days up in a row stacking gaps. And now the position's reduced. Still hold position in this one. Looking for a bigger move. If you look at the weekly chart too, this is a huge stage one base breakout. And coming off the heels of a strong earnings report in a strong China market. Fun fact, FXI and KWeb are actually outperforming the S&P 500 and QQQ since early 2024. Not that many people know that, as they've been dormant for years. But again, that's the relative strength telling you that, hey, maybe you should pay a little bit of attention to some of the China stocks and what they're acting. And you can see the big stage one base here on KWeb. So that was Baba. And then the other one is Tempest AI. And if you follow the markets a little bit, Tempest AI is notorious for crushing people that try to buy this stock on strength. And that's the character of this stock, is that, it's one you want to buy in weakness. So when you look at the chart action, you can just tell every time it tries to break out, it comes back in, and it's not necessarily doing anything wrong. But if you buy the breakout and it pulls back, well, you're looking at a 10% loss off the gate, and you have to manage risk that way. So this one, September 4th as well, was the entry. And again, like I mentioned with Baba, this had multiple reasons. You had a 60-minute stochastic, and you had a 60-minute stochastic entry. This stock was pulling back into the 21 EMA, and it actually wicked right off the 21 EMA that day. So again, if it broke the 21 EMA, it's the market probably telling me that I'm wrong at that moment in time. And then, so the first ad was at about $75 a share, and then followed up that day as well. So using the oversold technique, and then also using strength. So did another buy at $76 a share. And then on September 8th was the final ad, and that was into strength because had cushion from the initial buys off weakness, and the stock was starting to show a change in character as it was actually holding strength. And then September 8th was the final ad, and that did come in a little bit, but again, it never hit the stop. And you can see yesterday this had a really strong breakout day. So again, the 60-minute stochastic is especially useful for a stock that typically mean reverts and doesn't break out. Now Tempest did break out yesterday, but that's the first time, in since the start of the year that it's actually had a powerful expansion day. So it's to be determined if this can fall through. For now, it's just pulling back on light volume. And again, if this pulls back into the top of the base and gives a 60-minute stochastic entry, that would not be a bad spot to potentially add on to it as well. So that's the 60-minute stochastic. Don obviously taught us all about this at Revere, and it can be a very, very useful tool that not that many people talk about. So I thought these were pretty good examples of how we used it recently for clients at Revere.
Connor, the great thing about using this and these two charts that we just went through echo it all the time. It's the risk to reward. There is no guarantee that a 60-minute stochastic cross is going to work, but the stop that you're able to put in, we talk all the time about what should something do, right? What should it do? Well, it should behave like this did, like Tempest did, like MDB did. not like snow did, right? But if we're wrong, we're going to be out with a 5, 6, 7% loss on a small position. It's going to be a paper cut to the overall portfolio. But when you're right, you're making so many multiples of your R, which is your risk, your initial risk, that it's just lather, rinse, and repeat this one setup over and over again. And it works, plain and simple. It puts the odds in your favor for a multiple R trade. And as Connor mentioned, then take some profits to the upside when you're extended. They don't all work like this. There's frustration for growth investors going back to last week. For about the month prior to that, leaders weren't really performing the way we would have preferred them to. In fact, we moved the leaders indication on our trend gauge to neutral. The indexes were holding up just fine, but money was rotating into value names, and that's changed big time over the last week. And I talked a little bit about that in last night's video. Good stuff, Connor. Now we're going to turn it over to Todd. He's going to talk about something that we very rarely talk about on videos, but we do talk about internally as a team, and it's one of the tools that we use, and it's the 65-day. A lot of people also use the 63-day, and the reason is it's basically 3 months worth of data, but the 65-day exponential moving average as a way to catch the overshoot of the 50-day moving average. And some great examples he brought to the team's attention earlier this week, and we want to share it with you. So take it away, Todd.
Last few weeks, we've seen rotation, and we've also seen many of the follow-through day liquid leaders pause. And at that point, we need to make a decision on how we're going to handle our remaining positions in a lot of these stocks. And one of the tools that really came through and held well this past week is that 65-day exponential moving average. And we're going to simply go through 4 names that really show how you could have used this average as the ultimate line in the sand for your big winners. And one of those big winners that we all are still holding on to is Robinhood. And Robinhood is one we all got on the follow-through day, and our gains are well over 100%, upwards of 130, 140% on the post-follow-through day earnings run. So we've made some offensive sells along the way. We've gotten back into it, and then ultimately we're at a point where we have a trailing position in it. And this past week, the week before last, we saw a lot of these names just hugging that 50-day moving average, and ultimately Robinhood broke, and we can see that 65-day exponential moving average. It came down to intraday and held perfectly, and it hammered off of that 65-day exponential, which is exactly what we want to see. And again, it got added to the S&P 500, and that certainly helped it get off there pretty rapidly. Also, NVIDIA is another good example. NVIDIA isn't quite the winner that Robinhood was in this post-follow-through day rally. It's up maybe 60, 65%. But another example of one that got right down to that 65-day after kind of hugging that 50-day moving average and hammered off of it. So a good cue that, hey, there is support coming into this stock at that key level. Let's also look at GEV. This is one that's, again, another name that we all held and rode out through the post follow-through day level. At the top, it was over 100% gain, but it came down to that 65 EMA 3 times and held and hammered off of it. So it was showing support on that right along, and this week we gapped out of that. And last but not least, Palantir. Had some undercuts intraday, but ultimately held that 65. So there's quite a few more examples of this, but this is a nice technique to hold on to a winner that may be starting a new base after you've had big gains on and you've wrote it out and you want to hold a position, or maybe you want to add to that position. So if the 50-day doesn't hold, you may find that this level and this moving average is a key to help you get into a bigger position and or ultimately stop out. Thank you, Don.
All right, another tool for the toolbox. Thanks a lot, Todd. And let's take it over to Ted. He's going to talk about a stock that we've talked about for a while on here, one that had been taking 3 steps back, that being Tesla. Anybody that was buying it on strength was not getting rewarded until this week. Take it away, Ted.
Thank you, Don. Before I talk about Tesla, I just want to talk about 2 precedents we had in-house that we're using as a model, a template for our Tesla trade right now and our thesis. First one's NVIDIA. Everyone knows about NVIDIA. It's arguably the number 1 name in this entire AI revolution and bull market. And I just want to only talk about the characteristics. We won't talk about the fundamentals of the theme because everyone knows about it. We've talked about NVIDIA plenty of times. But just looking at the chart and the price and volume action, what we like about NVIDIA's base, first and foremost, is the symmetry and the VCP characteristics. And I've talked about volatility contraction pattern in the past. Pretty much, it's just as you look from the left side of the base, closer to where more supply is, you have these contractions. For example, right here is the first one. Here's the second one, and then here's the third one. And typically what you see in this action is that every subsequent contraction is about 1/2 of the previous one. For example, you see this is about 23% pullback. This is about 10, 11%. And then this is about just a tiny 5 to 6%, about 50% each time. And what that tells you when you read a chart is that supply is being wringed out of the market. Institutional strong hands are accumulating the stock away from the weak hands, which are being shaken out. And eventually, you get to the point where it forms this line of least resistance, supply is out of the market, and then when there's only buyers left, that leads to price action like that. And that made about 90% move in a couple months. Other additional features in a base that we would like to see, ideally, is an undercut reclaim that just really washes out the weak hands while strong hands step in. You can see this hammer off the 150-day, reclaiming this 41 level. And then you want to see higher lows and then super tightness. And that is really just the features of this type of multi-month base that we like to look for. And these types of setups come rarely. I call it the 2 to 3 times a year opportunity, just because really, if you think about it, it takes 4 to 6 months to just build the base. And then after you're done with the trade, it's probably really another 2-3 months. So you have 3/4 of the year already done when you're trading these types of setups. The next one I want to talk about is late 2024. We also have this one in-house, and that is MicroStrategy. Similar pattern too. You can see there's volatility contraction here. You have this first contraction, which this is a lot more volatile stock than NVIDIA, but went down 50%. Then you had this second contraction, which was about 39%. You can say this third one right here is just a small 13%. And from left to right, you have decreased volatility. You have higher lows. It's just made higher lows, so no undercut reclaim here. But you did have an undercut reclaim of this level. And you build higher lows, and you continue to build higher lows, and you get super tight on the right side. And eventually, that leads to no supply. Demand causes a huge move. So now back to the present. Tesla. This trade is just really getting started in our view. Let's take out 2 breakout days for a moment. You can see similar type of action. The difference is the other 2 were already in existing uptrends. Tesla, we zoom out, really has just been in the base. Sorry, I had markings before. Actually, I'll bring that back. I'll show a higher level perspective in a second. But Tesla really just has been in a 4-year range. And talk about the phrase multiple times. The bigger the base, the higher in the space. So we will see what happens. This has officially triggered the stage 2 breakout out of this massive weekly base. and really this huge range here. Now zooming back in, let's look at the features of just the right side here. You can see higher lows being built like this. And then you can also see the volatility is contracting. And this has many contractions. You can see this first one's about 25%. This one was then about 20. This one was about 11. And this one's about 8. This one is about 7. And now this super, super tight one is about only 4%. And the tighter you got, gave you the indication that it was ready to go. And you can see volume dried up in this consolidation pivot as well before this expansion candle above 358 and 370. And so, like NVIDIA, like MSTR, you're looking for higher lows being built in the base, volatility contraction from left to right, and then tightness. And that are 3 hallmark signs of a base potentially ready to break out. And from what we say, from compression comes expansion as well. And the final point I just want to talk about is just a super, super high time frame chart, a monthly on Tesla. And I got to make this log so we can have a better perspective. In Tesla's entire history since it IPO'd, its character is to go sideways for multiple years at a time. Then there's some sort of catalyst, and these previous 2 runs were caused by better than expected delivery numbers from the Tesla cars, better than expected earnings or revenue expectations. And those led to some pretty massive moves. The first one was about 700% gain. This one in the COVID run was about 1,500%. Now we're back to this multi-year or nearly 5-year base. And when we look at the monthly chart, it's really starting to trigger up now. So we still haven't had a definite catalyst, but we speculate that it could be some sort of humanoid robot news announcement, be something about robo-taxis beating revenue expectations as well, or just them scaling out the robo-taxi. Or it could also be something with advancements in full self-driving, Tesla semi-truck. We don't know yet. We haven't seen this definite news, but humanoid robots and robo-taxis are at the forefront of our mind. Tesla reports earnings as well mid-October, so we will see what happens there. And that's really it. The bottom line is we're just bullish Tesla based off its history of its trading and our precedents looking at these multi-month breakouts.
We're bullish because it's bullish. Not an opinion.
Bullish.
That's a fact displayed on the chart, plain and simple. All right. Thanks, Ted. What a team. What a great 3 great presentations. Very fortunate to be working with these guys, and this team. And Dan, you can take it on home.
Folks, always remember, price is truth, no exceptions. If you're arguing with price, you're arguing with truth. That's what the Revere team follows. They follow price and they follow truth. We don't have any opinion. We've got opinions. We just don't follow them. We follow price and we follow our rules because I'm trying to get out of my own way, right? Investing is very, very hard. And that's why we have rules. And if you want your money to be managed just like our money, come join the Revere team. And when I talk about just like our money, I'm talking about the exact same price and timestamp and performance tracking as my account, my mother's account, Don's accounts, our family accounts. We've got all of our skin in the game. Okay? We don't have other portfolio. We're not doing other stuff. We're doing all of this in real time and then sharing it every night the market is open. In fact, you can go up to revereasset.com, just go up in the right-hand corner, hit the subscribe button, and you'll get this daily market insight video every night the market's open. You'll get our daily podcast every Saturday morning. I'm recording this Friday morning. Actually, I'm in Texarkana. I'm traveling remotely. I'm staying at my mother-in-law's house. She doesn't have any internet, Wi-Fi. She's 85, lives out in the country. So I actually came in and rented a conference room at the Holiday Inn Express in New Boston. Anyway, but we can be anywhere. But we share our content wherever we go. And I do this podcast every Friday morning If you go to YouTube though and sign up for just search for Revere Asset and hit subscribe, Zach, our producer, will have this out in about an hour by 1 or 2 Central Time. That's how our stock nerds get it, and they can get it before the market closes that day. If you want a complimentary portfolio review, send the tickers and the percentage of your portfolio, like Don said, and then we can tell you within minutes exactly which positions you have at risk and which positions look good. And we make these changes on an ongoing basis. And folks, you can always call us old school at 855 Real Wealth. Okay? Remember, it's your money, not their money. We'll talk to you next week on Your Money.
Because it's not how much you make in the markets, it's how much you can keep.